I am Sunil Jain, Head of Research at Nirmal Bank. For outlook for the month of January, what we had seen that December month has seen some corrections and the Indian market has underperformed the world market. The key reasons for underperformance is the slowdown in the economy, specifically in consumer part of urban India, where we had seen decline or corrections in the buying activity of the consumers. Because of that, what we had seen that in last 2 quarters the result has come down, and Q3 also has not yet seen full revival. There are some improvement which are happening, but not to the extent which can see indicate that the economy is reviving. Apart from that, the underperformance was also driven by the FII selling. So that was one of the reason for FII selling was that the rupee has depreciated. It is now at around 85.5. That was driven as the dollar was appreciating against all major currencies. And apart from that, we have internal problem of larger current account deficit in the last month, so which has also put some pressure on the rupee, and rupee has depreciated. There is a direct correlation with rupee depreciation and FII selling, as they incur losses when the rupee depreciate. So they had done negative and were selling in the market. Apart from that, a lot of money got withdrawn from the market from the direction of IPO, QIP and OFS. So that has also taken out the money which was available for the secondary market has gone into all these instruments. So that is left with less money with the mutual fund or the other people to support the market. Apart from that, if you see government capital expenditure, which is quite low in first 7 months, which was somewhere at around 42% of the overall budget what government has targeted, against over 54% in the last year, same first 7 months. Even October month has also seen government capital expenditure declining by almost around 8%. So that is having its own impact on the economy, wherein the companies or corporates directly benefiting from these expenditure are lagging, and also this is putting up less liquidity into the system as government is not spending or spending less. But apart from that, the other thing is that RBI has taken some initiatives and indicated that the CRR rate cut of around 50 basis point has been approved. So this will infuse around 1,16,000 crores of rupees into the system, which will have some relief from the tight liquidity situations which the economy was facing. So that is also indicating that RBI is moving towards rate cut in the coming period. So quite possible we may start seeing rate cut cycle beginning in the February month. So from the policy side, specifically from the RBI side, we are getting first signals of some support to the economy from RBI. Going forward from here, what we see that now we will be looking at December quarter results. We are also getting some expectations build up in last few days about the results, and these expectations will drive the stock prices in the coming period. So a lot of sectors are not likely to report any great performance are FMCG, paint, steel and auto. So these sectors may not be able to give any great performance, whereas the banking and financial sectors will see a lower growth. But a lot of other sectors like OMC, capital market, new platform companies, electronic manufacturing services, and then distillery, solar, all these small sectors are likely to perform very well in this quarter. So overall Q3 results will be of a mixed bag, but what we can say that the performance which got impacted in Q1 and Q2, Q3 will see some revival, not to a very large extent, but some revival in traditional sectors, and some revival and sectors which continue to do well will continue to do well even in the Q3. So there will be some improvement from the last quarter, that is Q2, but not to a large extent. The direction of the results though will be some gain, but now the focus will shift to Q4 results. The Q4 will be then the management will talk about the Q4 results. What we expect that there will be further improvement in the performance in the Q4 results. So the direction wise, the results has made a bottom in Q2 and now we are seeing some revival, though at a lower pace. Apart from that, what we talked about the government capital expenditure. So the government capital expenditure in first 7 months remained very low. But what we see that if the government meet its capital expenditure target of around 1,11,000 crores in this year, then the growth in the capital expenditure for the remaining 5 years will be very high. If we compare it with the last year, then the remaining 5 years, if they meet this capital expenditure target, then will be over 60%. So that will have a very positive impact if that happens. And we don't see any reason why the government will not meet this target, as government has enough surplus in their budget in this current year. So quite possible that there is a high probability of capital expenditure being met in this remaining 5 months. So overall what we see that direction is now positive. We are likely to see bounce back in some results, though at a lower pace. RBI is supporting the market and there is a possibility that government will start doing large expenditure on the capital account in the coming period. So all these things is likely to support the equity market. We may see some volatility because of the result in the near term, but the overall direction is positive for coming month. Thank you very much.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from Nirmal Bang.